Howdy folks, and welcome back to another episode of Spy Trader. It's your pal, Chuck the Numbers Nut McFinance, here to guide you through the latest and greatest in the S&P 500 universe. It's 6 a.m. on August 16th, 2024, and boy do we have a bunch of juicy updates for you today. Summary of key news items. Let's kick things off with a quick recap of the key news that's been shaking up the markets. Global investors are on a bit of a safety kick, pouring $14.24 billion into money market funds and $2.6 billion into government bonds. Looks like folks are feeling cautious. Meanwhile, the recent U.S. jobs report wasn't exactly a home run, which sent equity markets into a temporary tizzy, but benign inflation and strong retail sales have since given them a boost. Despite the roller coaster ride, equity funds ended up with a net inflow of $857 million this past week. Tech and utilities saw the most love, while consumer discretionary funds, not so much. On the geographical front, European funds are making a comeback, seeing a net purchase of $6.57 billion, whereas U.S. funds saw a bit of an exodus with $8.92 billion flying out the window. Analysis and insights. All right, let's dive a little deeper. The current flight to safety suggests that investors are playing it safe amidst some economic uncertainties. This cautiousness is reflected in the S&P 500's recent performance. Though there's been a bounce back thanks to strong retail sales, it's clear that folks are jittery about where the economy might be headed. The tech sector's sizable inflow stands in contrast to the general risk-off sentiment, likely fueled by an ongoing faith in AI and tech. Meanwhile, Walmart's recent performance highlights the resilience of consumer spending. They've upped their full-year outlook due to strong demand, particularly among the more budget-conscious shoppers. Trading recommendations and reasoning behind them. So what does all this mean for us spy traders? Here are a few trading recommendations. 1. Tech stocks, like Nvidia. Tech is seeing strong inflows, especially with the ongoing buzz around AI. Nvidia, up 21% recently, is a prime example. Despite some volatility, the long-term growth potential remains solid. Buy the dip if you see one. 2. Consumer staples and retailers, like Walmart. With robust consumer spending despite inflation and Walmart's strong quarterly results, retail giants present a more stable investment. Walmart gained market share across all income levels and is poised for a strong back-to-school and holiday sales period. It's time to grab some Walmart shares. 3. Government bonds and bond funds. Given the $2.6 billion inflow into government bond funds, these are your go-to if you're looking to play it safe. With potential Fed rate cuts on the horizon, bond yields could look more attractive, giving you a nice cushion in uncertain times. 4. Utilities. With $850 million flowing into this sector, utilities are often seen as defensive plays. They offer stability and decent dividends, making them a good hedge when market swings get too wild. Number 5. Diversify with European funds. European markets are seeing a rebound and might offer some diversification benefits given U.S. market jitters. A net purchase of $6.57 billion in European funds suggests some confidence there. Consider balancing your portfolio with some European exposure. Remember, the key is balance. With potential volatility ahead, a mix of high-growth tech, stable consumer staples, and the safe haven of bonds and utilities will help you navigate through the stormy waters. And before we sign off, here's a joke to tide you over. What do you call a financial planner's autobiography? Life in accounts. That's it for this episode of Spy Trader. Keep your eyes on the market, and we'll be back in a few hours with more updates. Stay savvy, investors.